Taxes. They're a fact of life, but let's be real. Who wants to give away more money than they have to? You've heard of some common tax-saving tricks, but what about the strategies no one has talked about? If you're tired of watching your hard-earned cash vanish every tax season, this video is for you. Hi everyone, my name is Wendy, and I am a chartered professional accountant. In this channel, we will break down personal finance, accounting, and tax tips to help you save more and stress less. In today's video, we'll cover 8 tax-saving strategies that can help you legally reduce your taxes in Canada and keep more of your hard-earned money. Are you ready to take your tax knowledge to the next level? Let's jump right in. How taxes work in Canada. Before we dive into how to increase your tax savings, we will go over the basic concept of the Canadian tax system. Canada uses a progressive tax system, which means the more you earn, the higher your tax rate on the next dollar of income. Your income is divided into different brackets, and each bracket has its own tax rate. You only pay the higher rate on the portion of income that falls within that bracket. We'll start with a simple example. Assume you have gross income of $70,000. How much federal tax do you have to pay without considering any tax credits or deductions? As shown in the table, the first $55,870 of your income is taxed at 15%, and the remainder, which is $14,133, is taxed at 20.5%. When we calculate, your total federal tax liability comes out to around $11,000. Before we dive into the common and lesser-known tax-saving strategies, it's crucial to understand the foundation they're built on. Every tax-saving strategy falls into one of 2 categories: tax deductions or tax credits. To start, we'll first discuss the key differences between the two and why they matter. A tax credit is a direct reduction in tax. A $1,000 of a credit is worth exactly $1,000. On the other hand, a tax deduction reduces your taxable income, on which federal tax is calculated. In other words, a $1,000 deduction will give you about $250 to $500 in tax savings depending on your tax bracket. After going over the basic concepts, let's dive into the tax-saving strategies that will allow you to keep more of your hard-earned money. Tax credits. Let's begin by exploring the types of tax credits available. With a wide range of options out there, we'll focus on those that are most commonly applicable to most people in this video. Basic personal amount. The federal basic personal amount comprises 2 elements: the base amount, $14,156, and an additional amount, $1,549. The additional amount will be fully eliminated for individuals with net income in excess of $246,752. If you live in Ontario, the provincial BPA is $12,399, regardless of your net income. To calculate your basic personal tax credit, you will need to multiply your basic personal amount by the combined federal and provincial lowest tax rates. Medical expenses. Only medical expenses in excess of the lesser of $2,759, or 3% of your net income, can be claimed for the federal tax credit. How is the medical expense credit calculated? You have to multiply your eligible medical expenses by the lowest combined federal and provincial tax rates. Here are some key tips to keep in mind. Firstly, make sure to add up all the medical expenses for yourself, spouse, or common law partner, and your dependent children under 18 on one return. Second, the lower income earning spouse should claim the eligible medical expenses. Third, you can choose your own 12-month period for medical expense claims, depending on which period has the largest medical expense bills. Donations. When you donate to a registered charity or qualified organization, you may be eligible for donation tax credits. These credits reduce the amount of tax you owe. There are 2 types of donation credits. Federal tax credit. The federal tax credit is 15% for the first $200 you donate and 29% for donations over $200. Provincial tax credit. Each province has its own tax credit rates, which are added to the federal credit. Here are some key tips to maximize your donation tax credits. Combine 2 or more years of charitable donations into 1 year. If you have a spouse, combine your charitable donations and claim them on the higher income spouse's return. Once you are over the $200 level, consider making extra contributions in December rather than early in the new year. This way, your tax savings will come 1 year earlier. Even small credits can add up, so make sure you don't miss out on any savings. Tax deductions. Let's dive into the tax deductions available. This video covers the common deductions and includes insights that might be new to you, and wraps up with some lesser-known ones at the end, so make sure to stick around. Contribute to your RRSP and RPP. The first strategy is making contributions to your registered retirement savings plan. Contributions to your RRSP reduce your taxable income. The more you contribute, the less tax you pay. For 2024, the RRSP contribution limit is 18% of your income, up to a maximum of $31,560. Keep in mind that if you made contribution to the registered pension plan with an employer, it will reduce your RRSP contribution limit for the year. Employee contributions to RPP are also deductible against your taxable income. Remember, you have until the 60th day of 2025 to make contributions for the 2024 tax year. Let's run through some numbers to see how contributions made to RRSP can reduce your tax payable. TurboTax offers a free RRSP tax savings calculator, which I've linked in the description box below. Feel free to explore it and see how different contribution amounts can impact your savings. For this demonstration, let's assume the province of residence is Ontario, employment income is $100,000, and income taxes withheld amount to $21,000. After clicking the Calculate button, we see that there are taxes owing of $90. Now let's see what happens if we contribute around $7,000 to our RRSP. As shown in the calculator, this changes the outcome to a tax refund of around $2,000. Imagine what you could do with that extra cash, whether it's investing or using it for something meaningful today. It's a smart way to reduce your tax burden while saving for tomorrow. Breaking it down further, contributing $7,000 is roughly $600 per month over 12 months. By making a monthly RRSP contribution of $600, not only are you saving for the future, but you're also reducing the taxes you pay today. We'll be diving deeper into whether contributing to your RRSP or taking an RRSP loan makes sense for your situation in an upcoming video. We'll also cover the key factors you should consider when making this important decision. Make sure to subscribe to our channel and turn on the notification bell so you don't miss out on our latest tips and updates to help you take your personal finances to the next level. First Home Savings Account, FHSA. If you are a first-time homebuyer and a Canadian resident, the second strategy is for you. The contributions that you make to your FHSAs may be deductible on your income tax return for the year of the contribution, or a future year, giving you flexibility in managing your taxes. Currently, individuals with an FHSA can contribute up to $8,000 annually. Be cautious, though. Any overcontributions will incur a 1% tax on the excess amount. Over your lifetime, the maximum amount you can deduct as an FHSA deduction is $40,000. Additionally, any transfers you make from your RRSP to your FHSA will count toward this lifetime deduction limit. Since we are now in January 2025, it's important to note that any FHSA contributions made during the first 60 days of the year will apply to your 2025 tax return, unlike RRSP contributions, which can still be applied to the prior year. It's never too early to start planning ahead. Childcare expenses. Working parents will be able to deduct childcare expenses. The deduction can be claimed for a variety of childcare services, such as babysitting, day nursery, and attendance at a camp. Deduction is based on when the services are provided rather than when the amounts are paid. Prepaying in December does not give you the deduction a year earlier. The maximum annual deduction is generally $8,000 per child under 7 years old and $5,000 per child from 7 to 16 years old. Interest expense. What type of interests are deductible? The first one is the interest on money borrowed to acquire rental property. Let's look at a quick example. Assume you have taken out a mortgage to purchase a rental property. Your rental income for the year is $24,000. You have incurred mortgage interests of $23,000 and other expenses of $7,000. The mortgage interest incurred on the rental property can be deducted against rental income. If the rental property is generating a rental loss, this can be deducted against your taxable income and might even bring you to a lower tax bracket. In this case, the net rental loss of $6,000 will reduce your overall taxable income, ultimately reduces your tax payable. Another type of deductible interest expense arises when you borrow money to invest in stocks or bonds. The interest incurred on the borrowed money is tax deductible against your taxable income. Keep in mind that any capital gain incurred on your investment is still considered taxable. Borrowing to invest may be an appealing strategy to save on taxes, but this is not for everyone. There are important considerations to keep in mind, such as investment risk and market risk. Borrowed money will amplify those risks. Be strategic and informed in your approach. Last but not least, capital gains and losses. The unrealized gains or losses in your investment account can become taxable capital gains or deductible capital losses if you sell them before December 31st of the year. This is also known as crystallization. Let's look at two scenarios. First scenario, selling the security at a profit. This is referred to as crystallizing a capital gain. This can be advantageous due to the new rule that came into effect on June 25th, as announced in the 2024 federal budget. For individual taxpayers, the capital gains inclusion rate of 50% will apply to the first $250,000, and the increased capital gains inclusion rate of 66.67% will apply on capital gains in excess of $250,000 threshold realized on or after June 25, 2024. Let's first look at the example with crystallization. Assume you have sold your investments at the end of year 1 and repurchased it immediately after. At the end of year 2, you then sell the same investments. With crystallization in year 1, the total taxable capital gain of the 2 years is $160,000. Without crystallization in year 1, the total taxable capital gain at the end of year 2 is $171,690. That's a $11,690 difference. Crystallizing a capital gain can be a smart financial move, but keep in mind that crystallizing gains increases your taxable income and might bring you to a higher tax bracket in year 1. Be sure to consider whether you have the cash flow available to cover the tax payable on capital gains. Carefully assess your financial goals, the market conditions, and your overall tax situation before making a decision. Now you may ask, what about crystallizing a capital loss? Here are a few reasons why you might want to crystallize a loss. One of the reasons being you can use the capital loss to offset capital gains in the same tax year, reducing the taxes you owe. Another reason is, unused capital losses can be carried back up to 3 years or forward indefinitely to offset future capital gains. Although these advantages are compelling, there are a few things you should consider. First is the superficial loss rule. If you buy back the same or an identical investment within 30 calendar days, the loss won't be deductible for tax purposes, and it is known as the superficial loss. This means the loss that you claimed will be denied by the CRA. Second, opportunity costs. Make sure selling aligns with your long-term investment strategy. The asset could recover in value if held longer. Crystallizing a capital loss can reduce your taxes, but careful planning needs to be done ahead. To wrap up, we've covered 3 types of tax credits to help you save directly on your taxes. We also discussed 5 types of tax deductions that can lower your taxable income, potentially placing you in a lower tax bracket and reducing your tax payable. These tax savings can enable you to achieve your goals, whether it's buying a car, saving for a home, planning a vacation, or investing in your retirement. Thank you so much for watching until the very end. If you find this video helpful, don't forget to like, share, and subscribe for more personal finance and tax tips. See you in the next video.